Welcome to another video. If you're new to the channel, I'm a top author on the TradingView platform as well as running an educational program and swing trading full-time with my students. In this video, we will be speaking about the exact way in which you're supposed to be using the Fibonacci retracement tool. So if you ever wondered how is the best way to do it, well, in this video, you will get the answer. So without further ado, let's get straight in the video and give you the correct answer on how you're supposed to be using your Fibonacci tools. Okay, so let's first start by defining which are the best settings for your Fibonacci retracement tool. So first of all, which are the best levels that you're actually supposed to be having on your chart? So this is simply which are the best. Okay, 382, 50%, there's not a Fibonacci level, but it means that basically it's 50% retracement of the actual move to the downside or to the upside. Then we have obviously the golden ratio, 0.618, minus 27, minus 0.618, 78.6. These are the best Fibonacci settings that you're basically supposed to be implementing when you're actually trading. Now let's go and see how you can actually use them to identify the best levels in the market of support and resistance. So first of all, let's define the way in which you're supposed to be using it, okay? So the simple and most effective way to use it is to always use the Fibonacci retracement tool on the previous leg. What does it mean? It means that if you have an impulse to the downside, okay, what you will be doing, if you want information on the retracement, you want to know which are the most important levels of resistance during this retracement. Well, the simple way to do it is just taking your Fibonacci from the high to the low of the impulse, and you will get several levels, right? You will get, for example, your 382, okay, your 50%, your 61.8, and your 0.786, which these are the most important levels of resistance that the market will encounter in its push to the upside. And obviously, how do you know at which one of these levels the market will actually reverse? The answer to this is very simple. I will be giving it later on in the video. Let's go step by step. There is an easy way to understand at which level the market is actually supposed to reverse. But that is something that we'll be speaking about later on. So now that we identified which are the strongest levels of resistance, let's say the market starts the next push to the downside from the 0.786 Fibonacci retracement. Okay, starts the next impulse to the downside. Now at that point, when the market starts the next impulse to the downside, you want to identify which are your target areas, right? Let's say you found a good entry inside of this area, okay? And you want to know which are the best target zones for the push to the downside. What you will do? Well, to answer this is very simple. You just click on your Fibonacci tool, and as we said earlier, the best way to identify levels in the market is to use your Fibonacci retracement tool on the previous leg. So in this case, how you will do it? Simply moving your Fibonacci from here to here, okay, on the previous leg. Because if you want information on this push to the upside, which was obviously the retracement, what did we do? We took the Fibonacci on the impulse, and in the exact same way, if we want information on the next push to the downside, how we will take our Fibonacci on the previous leg. So from this high to this low, and we will get two levels, two target zones at which basically the market can actually reverse, okay, and start the next retracement. Because what do we know? We know that the market moves in waves, okay? The market just doesn't move in one straight line, okay? Always creates retracements and impulses along the way. This is how the market moves. And those retracements and impulses are the key when it comes to swing trading. Why? Because you want to buy from here and sell from here. That is the whole point of multi-time frame analysis as a whole, right? Because if you identify the swing points on higher time frames, you can then go on lower time frames and actually perfect your entries. But that is something that belongs to another video. So what we were speaking about, okay, we have two targets area. The first one is the minus 0.272. The second one is the minus 0.618. Now, most of the times the market will actually make it and reach the minus 0.618. However, which is the area at which, if you took your good sell order here, you will actually be taking profits. Well, to be sure that your take profit actually gets hit, my suggestion is that you look to take your profits few pips above the -27 of the previous leg, as we just said. Okay, so just to make sure, but most of the times the market will actually make it to breach this level and make it all the way down to a -0.618. So let's give, this is pretty simple, right? Straightforward. If you want information on leg, you just take it on the previous one. Now let's go in a real-time chart and see basically how we can apply these concepts. So I see one straight in my face, okay? See a nice impulse here, okay? So we have a very nice impulse. The market went up from here, made a retracement and created this beautiful impulse to the upside. Now, at some point, as we said before, the market just doesn't move in one wave, okay? It will create waves along the way, meaning that it will create retracements along the way. So what we can expect after this impulse to the upside, we can expect the market to actually make a retracement. So how we will be determining which are the strongest levels for the push to the downside. I will also now answer to your simple question at which Fibonacci level we can expect the market to actually shift. And how do we do it? We already said it, right? If you want information on the retracement, we take our Fibonacci on the impulse, right? But let's first give the market the time to start the retracement. So now the market started the retracement and we took our Fibonacci. So at this point, what do we have? Just a quick reminder, make sure you comment below and you let me know which topics you would like me to cover in the next video. At this point, we have several levels that the market can actually hit, right? 0.382, 50%, 61.8, right? Golden ratio. So at which level the market will actually stop? At which levels we have to go on lower time frames to actually perfect our entries, because we know that we have very high probabilities of the market to actually shift away from these zones? Well, the answer to this is very simple. You have to look left and check the structure. The Fibonacci level that is lining up better with structure is the Fibonacci level that the market will actually hit and reject. So in this particular case, which one is it? Well, in this case, it's obviously the golden ratio, right? Why is it the golden ratio? Because it is the one that is lining up better with structure. We have clearly previous resistance here, which is turned support at this level, and we can expect the market from here to make a nice push to the upside, right? So bringing back our Fibonacci level, as we said, we can expect the market to actually go down, hit the 61.8, and then from there, okay, start the actual move to the upside. And as you can see, the market hit the 61.8 and then obviously we got the rejection. Now, how do we know that actually this was the most precise level? Because as we said, we had confluence at the zone, okay? We had previous resistance turn support lining up perfectly with the golden ratio. This is a very, very powerful confluence zone. There is a strategy that you could completely base on these things if you know how to read price action all lower time frames, because just because you know that from here the market has high probability of shifting direction, this is the weekly time frame. If you're able to go on, for example, the 4-hour time frame, right, and perfect your entry, know exactly how you can take a high risk to reward trade there, then you have a pretty killer risk to reward for the push to the upside. We're speaking about more than 1 to 5 risk to reward to the upside, but you need to know how to actually structure a strategy and how to read the market on lower time frames and take high probability trades. Now that we identified which level the market was supposed to shift for the push to the upside, let's go to the second step, right? We took our long and said, let's say on the 4 hours we found a perfect entry for the push to the upside. Obviously, I will not go on the 4 hours because first of all, I can't share with you my rules for entry. Second, because as part of the mentorship program. Second of all, it's not what we're supposed to be speaking about in this video. So how we will actually identify the push to the upside? We already said it. We will just take our Fibonacci on the previous leg. So from this low to this high, right? So from this low to this high, and what we will have? We will have 2 possible upside targets. So it's the exact same thing we did last time, okay? In the example, from the low, we just move our Fibonacci on the previous leg, exactly as we did in the example before. And what do we have? 2 target zones, -27, -618. And we can expect the market, we want to take our profits here. However, most of the times the market will actually hit the second level. Specifically, in this case, what do you have? This level is lining up perfectly with this previous high. So we have very high probabilities that actually in this case the market will make it to the second target. So let's see if the market actually makes it to the second target. And yes, it seems the market makes it to the second target, and look how accurately the market rejects it. Okay, when the market hits this area, it will reject, okay, most of the times. And on the 4 hours, you can be looking for a possible shorter position if you know how to read price action. So you will also be able to basically write the retracements if you know where you're actually supposed to be waiting for rejections, and definitely structure and Fibonacci can help you a lot with that, and that is the reason for which I wanted to make this video. If you enjoyed the video, make sure you smash the like button and comment below. It really does support the creation of more free education for all of you, because it obviously helps with the YouTube algorithm. And I will also invite you to go and check out the mentorship program. You find the link in the description. It's a very complete program. You first get all the rules of my strategies, and then you trade them live with me. Each and every day you get a new daily market breakdown showing you exactly how you're supposed to be using the strategies with entry, stop loss, take profit, as well as having me answering every question that you have each and every day. So I will invite you to go and check it out, or go and check out the next video.